$20,000 in annual retirement income from Treasuries could vanish in 18 months, and the Fed's guidance isn't telling you why. Here's what most retirees believe. Treasury yields of 4 to 5% represent a stable income floor because the Federal Reserve has signaled lower rates ahead. That's the mainstream read. But alternative analysis of Federal Reserve H.4.1 holdings, foreign central bank reserve data, and Treasury market microstructure suggests the opposite. Structural demand is fragmenting, and yields could compress or spike with minimal warning, disconnected entirely from Fed cuts. By the end of this video, you'll understand 3 specific signals in Treasury data that suggest yields are more likely to compress than experts admit, and what that means for a $500K retirement portfolio before your withdrawal strategy locks in. Let's start with the wrong belief most retirees carry. Imagine a household with $500,000 in Treasury ETFs or individual bonds earning 4.5%. That's $22,500 in annual income, predictable, safe, essential to a $150K retirement budget. The consensus narrative says, hold tight, the Fed will eventually cut rates, yields will normalize downward slowly, your income floor is secure. That narrative feels true because the Fed chair says it, but here's where the alternative reading diverges. Federal Reserve H.4.1 release data shows the Fed's own Treasury holdings have compressed to $4.1 trillion, down from $5.8 trillion in 2021. That's quantitative tightening at scale. Simultaneously, foreign central banks have reduced their U.S. Treasury holdings to 20-year lows. BIS data indicates foreign official holders now own approximately $7.2 trillion, a structural decline accelerating since 2022. Why does this matter? Because those foreign holders, central banks in Japan, Switzerland, China, Saudi Arabia, have historically been the demand floor for U.S. Treasuries. When they diversify reserves into gold, euros, or yuan instead, U.S. Treasury auction demand softens. The Fed isn't replacing that demand. It's shrinking its balance sheet. That creates a demand vacuum. Here's the hidden structural signal. Treasury market microstructure data from the Federal Reserve's quarterly surveillance report shows bid-ask spreads on 10-year Treasuries have widened to 2-3 basis points in normal trading, up from historical 1 basis point. That spread widens when buyers are scarce and sellers are nervous. The volatility indicator is flashing, so if structural demand collapses faster than the Fed cuts rates, what happens? Yields don't fall, they stay elevated or spike. A $500K portfolio at 4.5% earning $22,500 annually suddenly faces pressure. If yields compress just 100 basis points to 3.5% due to structural demand collapse, income drops to $17,500, a $5,000 annual cut, or 22%. If yields compress 150 basis points to 3%, income falls to $15,000, a $7,500 annual shock, or 33%. But there's a worst case. If foreign demand dries up faster than anticipated, yields could stay elevated longer, trapping retirees in a choice between locking in lower income now or waiting for volatility that never normalizes back to historical patterns. The data point nobody's discussing. Real yields, nominal yields minus inflation expectations, are near 2%. BLS inflation expectations via TIPS break-even rates suggest markets see inflation stickier than Fed guidance admits. If inflation stays above 2.5% and yields stay above 4%, real yields stay elevated, which means foreign buyers have no incentive to re-enter the market. No incentive means no structural demand recovery. Here's what retirees should monitor starting this month. Watch the Treasury auction data each week. If foreign participation drops below 30% of new issuance, that's a yellow flag for demand contraction. Monitor the Fed's balance sheet. If QT accelerates, domestic demand is shrinking. Check TIPS break-even inflation rates weekly. If they compress below 2.19%, the real yield floor collapses, and yields may follow. The alternative reading is this. Wall Street consensus assumes the Fed's rate guidance controls the timeline, but structural demand fragmentation could force the market to reprice Treasuries independent of Fed action. For a retiree holding $500K, that means income stability. The entire premise of the retirement plan could depend on forces the Fed doesn't control. Same data, different reading. Follow the trail.